I think it is clear to believe in the power of ideas.
Fresh thinking to the Manhattan Institute.
If I could have everyone's attention, please. Thank you. I realize people are going to still be enjoying their dessert and their coffee, but we want to bring up our Luncheon keynote speaker so that you all get a chance not only to hear him, but to have some time to ask him questions. So it's my pleasure to welcome Professor Hal Scott from Harvard Law School, where he's the Nomura Professor and Director of their program on international financial systems. Professor Scott is also one of the leading thinkers in the country on capital markets competitiveness more broadly in the U.S., and as I mentioned this morning, he chairs the Committee on Capital Markets Regulation that came out with the first of the 3 seminal studies looking at the competitiveness of the U.S. capital markets. His complete bio is available in your packet, so I'm not going to run through all the accolades that I could throw his way. Rather, I'd like you to all listen to him and hear what he has to say. So, Professor Scott.
Let me begin by thanking the Manhattan Institute and the Chamber of Commerce Institute for inviting me to speak here. And I also want to commend the Chamber on its excellent paper, which I thought was really revealing on a number of points. What I want to do today is talk about the competitiveness of U.S. public equity markets as related to this securities class actions phenomenon. So I'm going to begin by talking about competitiveness, and then I'm going to turn to what the committee thought we should do about the issue of class actions. The committee tracks 13 measures of competitiveness. I'm not going to bore you by going through all 13, but I want to talk about 4, and we've updated these numbers since our report in November 2006, and we track all of them on a quarterly basis now, and we put them up on our website. So, first number is the percentage of global IPOs by foreign companies. Now, what we're talking about here is if a foreign company goes public, what percentage of their capital is actually raised in the U.S. public market? Okay. So if you go and look at this historically from 1996 to 2005, it was about 30.9%, call it 31%. Year-end 2007, it was down to 6.9%. And first quarter of 2008, it was 1.8%. Okay, so we're getting hammered, okay? The foreign companies who are raising money are not coming to U.S. public markets. A second statistic is the use of Rule 144A. Rule 144A is the raising of capital in a private market without a lot of the exposure, legal and otherwise, that you would have in a public market. So this has always been an attractive market. So historically, of the capital that foreign companies raised in the U.S., they always raised a lot in the private market. So in this historical period, again, 1996 to 2005, we're talking about something like 61.9%. Year-end 2007, 87.9%. First quarter of 2008, 95.6%. So foreign companies that are coming here to raise capital are not using our public markets, they're using the private markets. A third statistic, which was mentioned by the panel, is the almost unprecedented idea that a U.S. company which is raising capital in an IPO would not raise it in the United States. I mean, almost every company starts in its home market where it has identification and investor relations, and they may go out from there. But in 2007, I think the number was given of 9%, which is by the number of companies, but by value was 4.2%. And, as I say, you're sort of going away from your natural investor base, and we have legal rules called Regulation S that say if you do this, you can't sell to a U.S. resident investor for a year. And yet companies are doing this to escape the U.S. public equity capital market. And then finally, foreign delistings. These are companies that have come here and decided to leave. So historically, every year maybe, this is from the New York Stock Exchange, not all exchanges, that every year, historically, it would be about 5.2% of listed companies would leave. This is by number. By year-end 2007, it was 15.1%. People are headed for the exits, okay? So that just gives you an idea. Oh, and by the way, some people said, well, that's because the SEC changed its rule in 2007, made it easier for these companies to leave. This is just pent-up demand to leave. Well, in the first quarter of 2008, it was only 11.4%. So, bottom line, we have a very serious problem of competition in our public equity markets. Now, why do we care about this? Why is this important? It's not about IPO fees. That plays a part, but that's not really why we care about this. First, we care because it's leading to less U.S. capital formation. Less money is going into venture capital investment, and the National Association just did an interesting report on this, due to the less attractive public exits. People don't want to exit to a public market. By the way, when you exit, you don't exit immediately. You sell pieces of your shares over time. So a venture capital firm that's exiting to a public market lives in that public market for a substantial period of time. Second reason we care is that it's a signal from these foreign companies which have a choice that public markets for the U.S. companies, who practically have large U.S. public companies who are trading here, really can't get out of the United States, that these companies are saddled with an inefficient capital market. That's why we care, that a signal is being sent from this competition information about how bad these U.S. public capital markets are for U.S. companies that have no real choice of leaving. Third, there are fewer investment choices for U.S. retail investors who are shut out of private markets and are not familiar with or do not trust foreign markets. There is the impact on the financial industry, which we should not minimize. Losses of jobs, and then as a correlate losses of taxes. The U.S. securities industry is extremely important to the U.S. economy. Financial services accounted for 7.8% of U.S. GDP in 2006, which is roughly the same as England. We have this idea of financial services as king in England. It's not so important here. That's just wrong. And then finally, there's just a vast economic literature showing that a thriving financial system is an important requirement for economic growth. We're starting to see that come true in the subprime crisis, where the instability and disruption in the capital markets is hurting our economic growth. So the next question is, well, why have U.S. public equity markets lost their competitiveness? What's the reason for this? Now, I think fair to say there are a lot of reasons. First of all, there are better home markets. A Mexican company 15 years ago that couldn't raise capital except for coming here can now actually raise capital in Mexico. And there are better alternative foreign markets so that Mexican company could go to the UK rather than coming here. Those foreign markets are more liquid and better regulated than they ever were. This is a result of globalization. We should actually celebrate this. Secondly, there's more money outside the U.S., so there's less need to come here, the China, India phenomenon. We have better private markets, okay? So the rise of private equity, the rise of the ability of private equity firms to sell in auctions to other private equity firms. The whole development of the Rule 144A market. Our private markets are much better. And then finally, we have higher regulatory and litigation costs in the US, which is where we get the intersection with this conference. So the next question is, okay, are litigation costs really a significant cause of the loss of competitiveness? And I think the answer to that is yes. Based on all my conversations with people in the market, if you ask what is the number one reason foreign companies don't want to come here and private companies don't want to go public, it's securities class actions. They're up here, Sarbanes-Oxley's down there. This is, in a sense, detailed empirically by the McKinsey study, by the Financial Services Forum, and the Chamber mentions this in their excellent paper. And then Lovells, the law firm, also did a survey on this, coming up with the same conclusion. Secondly, how can you explain the boom in the Rule 144A market except for this? Because that market is less liquid, has less of a premium, but yet people still use it over the public market because people who use that market are not subject to regulation under the 34 Act, and they have less litigation exposure. They have 10b-5, but they don't have 10b-5 tied into specific disclosure obligations, and if they're going public, they have nothing like Section 11, which is almost a strict liability statute. Third, foreign market competitors have trivial private securities litigation. Okay, so if you want to compare why they're doing better, one natural reason might be they don't have this system. U.S. securities class action settlements in 2007 were, as people have stated already, $7 billion. Now that's down from $17 billion in 2006, but $7 billion is $7 billion compared to other markets where that cost does not exist at all. And we have there are much lower regulatory costs abroad. So if you look at public monetary sanctions imposed by the SEC in 2007, they were $500 million. By the way, as 2004, they were in the billions, 3-point-something billion, but that was still on the crest of the WorldCom et al. Scandals. They're down to $500 million. In the UK, they're $5 million. Okay, so again, much less regulatory costs. Now, some European countries, not the UK, I might add, even after long thought, have adopted class actions, but they're much more limited than in the US. First of all, some of these statutes exclude securities actions. Secondly, there are restrictions on who the plaintiffs can be, and there are no contingent fees in most of these countries. And finally, and this is interesting, that almost all of these statutes are opt-in class actions rather than opt-out. So somebody has to make a positive choice to join this action. Under our system, unless you put up a beef, you're in. Now, I don't read any of this stuff if I ever get it, so I'm going to be in every class action that was ever brought. And by the way, I'm not going to collect anything either because I don't want to read that material. So we have some European countries that have adopted procedures, but they're very different from ours. So the point is that when you compare the burden, litigation or regulatory burden in the United States to our market competitors, we're up here, they're down here. So what did we, the Committee on Capital Markets Regulation, say we should do about this? We concluded that there was a very uneasy case for class actions. We didn't say they're terrible, throw them away. What we said was there was a very uneasy case, and much of that case has been discussed already. On the compensation side, there are small recoveries as a percent of potential harm. There are large attorney's fees, and there's a low level of collection by retail investors. We're doing a study right now trying to document, well, the investors get 2 to 3 cents on the dollar. Did they ever even get that? Did they ever come to get it? And I think the answer from what we can gather is no, they don't come to get it because it's a waste of time. Institutions generally are not interested in pursuing these actions, but obviously if there's an award, they've got to collect it, there's money on the table. Institutions are lead plaintiffs in only 14.7% of these securities class actions. And of those, labor unions and pension funds are lead plaintiffs in 68%. So, this is not being driven by fidelity. Studies also show, and there's been some talk about this, Jim mentioned it, that diversified institutions may actually make as much from securities fraud as they lose from securities fraud, because if they're sellers, at inflated prices, they actually gain from this fraud, right? And some people have modeled this recently and said, if I'm holding a diversified S&P 500 portfolio, where do I come out? I actually gain from securities fraud. And then secondly, there's this whole circularity in the settlement process, which people have already discussed. So, a weak case for compensation. There's also a weak case for deterrence. Did Bernie Ebbers really care that WorldCom would pay billions in class action settlements if his frauds were discovered? I don't think so. We then have the D&O insurance phenomena, where basically, the insurance companies wind up paying and funding most of these settlements. And recent studies have shown that they don't monitor corporations to reduce the possibility that they might someday have to pay the insurance, nor do they price the insurance based on the risk of class actions, because they cannot predict with any accuracy the probability that a company would be exposed to a class action. So the monitoring function of the insurance industry is not there, and individuals don't bear the risk because the insurance companies pay. There are the occasional cases of WorldCom, for instance, and Enron, where directors were liable, but they're extremely unusual. We talked about the heavy U.S. The Institute talks quite well about the U.S. civil and criminal enforcement system as being there. I should say, though, that let's remember that class action settlements in 2007 were $7 billion compared to $500 million in fines at the SEC. All right, so, there is a case that we're not getting enough deterrence. Maybe he agrees. I don't know. When you think about deterrence, to me, the biggest deterrent of all isn't class actions or the SEC, it's the market. The toll the market exacts for the disclosure of significant wrongdoing. One study showed that for significant wrongdoing, the average fall in share price is 41%. This is a study by Karpov. So it's really the market that, in my view, is the major deterrent of these frauds. And by the way, these frauds are not being, uncovered by Bill Larac. He's just looking what the SEC does, or reading the newspapers and looking at falling share prices. It's not really the private attorney general who's out there uncovering fraud. That's not what's happening. So, what did the committee propose to do about this? We concluded that given the uneasy case, the decision as to whether to have, and this is a little bit related to Adam's sort of recommendation. We recommended this in 2006. The decision as to whether to have securities class actions or not, and in what form, should be left to shareholders of individual companies. This should be a matter of shareholder rights, what kind of litigation system they want. This is sort of related in some way to what you were proposing on the measure of damages. The shareholders would determine it. So, for example, we said shareholders should be able to provide for arbitration of disputes without class actions, if they so wanted, through amendment of their bylaws. And Bloomberg-Schumer report actually endorsed this idea. Note that this proposal goes much farther than the kinds of procedural reforms we were talking about. And it doesn't necessarily, probably doesn't in our view, involve the legislature. This is a reform that, like Adams, could be undertaken by the market. So what's the legal framework for this? Why is this okay? Well, the Supreme Court, in two cases in the late 1980s, decided that arbitration agreements between customers and brokerage firms did not constitute a waiver of rights of these individuals under the Securities Acts, because they were not waiving any rights. They're anti-waiver of rights provisions in the Securities Acts. They were just choosing how they wanted to enforce these rights, not waiving the rights themselves. So going to arbitration, they weren't waiving the right. They were just saying, I want to vindicate this right in arbitration rather than in a lawsuit. And the court also held that such agreements were not adhesion contracts, that is, forced contracts on individuals, which can be thrown out by courts if they think it's sort of unconscionable. Well, following these cases, a company came to the SEC and said, we want to do an IPO, and in our IPO, we want to insert a clause that there's going to be a mandatory arbitration without class actions, okay, if you buy stock in this company. Assistant General Counsel of the SEC in 1990 said, we're not going to permit this. We're not going to allow the extension of these Supreme Court cases, which dealt with customers and brokerage firms, to public offerings, shareholders in their company. I think the opinion is extremely poorly reasoned. Now, this opinion could, of course, be retracted, but that would cause a lot of waves. Our proposal actually doesn't require that, because what we proposed is that the shareholders be able to amend their bylaws to provide for no class actions in arbitration, not be able to do this in the context of an IPO. And that was sort of on a policy basis, because we said, look, an IPO, and maybe this was a little bit what was behind this SEC opinion, people are not worried about this issue in an IPO. It's all price. So, we want people to focus on this issue separately. So if you do an IPO, come back for a special meeting whenever you want and do it that way. So there's a yay or nay just on this issue. Now, we also believe, as a matter of corporate law, a majority of shareholders can bind existing and future shareholders. This is an issue for Adam's proposal as well as ours. Existing shareholders who do not like the change can sell, and future shareholders can be given adequate notice that, if you buy the stock of this company, there's such a provision in its bylaws. Further, case law generally upholds mandatory arbitration in the consumer context. This often comes up in credit cards, where you're given a credit card and say, yeah, if you take this credit card, you've got to arbitrate all disputes. You can't sue us in a class action. Most courts have upheld challenges under two conditions. First of all, there cannot be a financial burden on the plaintiff, because the plaintiff is giving up this collective action, whereas burden is relieved. He is now being forced to pursue an individual action against the company, which can impose a burden on the plaintiff. So the courts have said, we got to worry about that. So many companies sort of say, we'll pay your fees, or we'll give you contribution of fees to get rid of that problem. And secondly, there's got to be adequate notice. It just can't be sort of buried in, little type at the end of 1,000 pages. And that can be, we lawyers are good at figuring out ways to give adequate notice. So I think you could design our system with maybe even an asymmetric fee structure, so the loser corporation would pay the plaintiff's fees, but the loser plaintiff individual would not. And maybe that would take care of the financial burden issue. Now, so that was our proposal. Has anybody done this? No. So that raises an interesting question as to why. Why aren't people doing this? And by the way, I have spent countless hours talking to countless companies about this, so it's not that we didn't try. So why aren't they doing it? First of all my talks with institutional shareholders say, we're not going to push this, but if it comes on the ballot, we'll go vote for it, okay, because they know this is not in their interest. Investor groups, interestingly, although they would oppose the proposal, will not oppose the shareholders' right to decide this, because they would be sort of in a difficult position as investor advocates if they say, oh, we don't want shareholders to vote on this. So, they'll say, yes, the shareholders should vote on it, but we're going to be against it. So why haven't companies done it? Well, I think there are a number of reasons. First, there is a fear that ISS and other advisory groups will oppose it and that they will be sucked into some public controversy as a result. This is the good corporate governance groups are saying it's bad for shareholders to give up a right. Now, we know that it actually could be good for shareholders to give up this right, but in the rhetoric, okay, shareholders giving up a right sort of sticks out there. And you got to explain, well, it's really not because they're going to benefit, blah, blah, blah. Actually, there was a company called Rio Tinto, which is a UK-Australian company that is listed in both the UK and Australia as a dual-class share structure, that proposed to amend its Articles of Association. Now, this is the company acting, not a shareholder-initiated proceeding, to provide for so-called exclusive jurisdiction, which means that litigation against this company could only be brought in the UK. They didn't want it in Australia because there were class actions available in Australia. So ISS jumped up, said, oh no, we're against that. Shareholders are giving up a right. So I would predict that they probably might react the same way to our proposal. There's also a fear that any company that did this would communicate, so we have something to fear. We're going to give up these class actions because maybe we would be sued in one. So there would be all the PR people in the company would be saying, well, you maybe should do this because you'll be sending a message to the market that you're not a good company. Also, many small companies who I talk to say, we got other priorities. I mean, this is going to be burdensome. We're going to have to handle this whole thing just to get it done. And after all, we have a low chance of being sued. Now, I was struck by the Chamber's numbers. It's really interesting that since 1996, I think your numbers were that 41% of all listed public companies were sued. That's the good news for our point. The bad news is last year only 2% were sued. So I constantly encountered this. It ain't going to be us. We're not going to be sued. And then there were concerns about arbitration. Actually, there were people on our committee who said, we don't like arbitration. There's summary procedures, you can't appeal. But you're getting rid of class actions. I know, but we're really uncomfortable with, and maybe somebody would say you could still bring a class action in arbitration even though you provided in the actual agreement you could not. There would be some risk of that. So we're not big fans of arbitration. But actually, and on the other side, by the way, there are recent attacks on the unfairness of arbitration, which you alluded to. But that's really, with respect to FINRA and customers, ours is going to be a neutral third party. This isn't the securities industry, whatever problem there is with it. It's not the securities industry that would be the arbitral forum. So in our proposal, you would choose a neutral forum, not the industry as the arbitrator. But finally, I think it comes down to what I started with, fear of controversy, fear of being the first mover. Because countless companies said to me, well, if 4 or 5 other companies do it, I'll do it. Of course, this makes perfectly good sense. Now, how do you get them to do it? Now, in some ways, corporate America has itself to blame. Because they don't have the guts to step up to the plate and do something about their own problem, okay? So they deserve a share of criticism for this. There are alternatives, by the way, to the arbitration. And I've used that as an illustration. You could waive jury trials. You could have opt-in class actions. You could do something like Adam provided. The whole idea is there could be multiple solutions that would be adopted on a company-by-company basis by shareholders as a matter of shareholder rights. So how can we overcome, oh, by the way, whatever the problems that we have in getting the market to do anything, I'm sure those of you who are legislative pros know how difficult it will be to get the legislature to do anything along the lines of the legislative reforms. So by the way, we talked a little about other reforms in our report, but it occurred to us that the market has the possibility to solve this problem if they show a little courage, okay? So how do we get there? Well, I think the first thing is we need to work with investor groups to shape an acceptable proposal, with responsible investor groups, okay? So maybe there's some version of this, whether it's Adam's version or arbitration or something that people could actually live with, okay, and get behind. I think there has to be more public discussion of this approach, okay? So I understand why there's this focus on the legislative solution, but if people basically said, this is a shareholder rights issue, let's let shareholders solve this problem, I think getting more attention to the idea would help enhance the idea, more attention from credible industry sources. And finally, there's the good old SEC. One of the things that's kind of irritated me is that I can tell you that both Paulson and Cox know that this is the #1 problem for the competitiveness of our capital markets. No doubt about it. Has either of them made this a focus? No. The SEC won't even hold a roundtable on this. What they want to do is allow foreign companies, foreign exchanges that are beating our brains in to come into the U.S. with less difficulty, so they can even compete more and beat in our brains even more. Right? This is the whole substituted compliance proposal. So, what are my conclusions? The U.S. public equity capital markets are becoming less competitive. This is important to the strength of the U.S. economy, and now we have, of course, double whammy on our capital markets on the debt side with subprime and on public equity with competitiveness. The U.S. has a lot of strengths in this competition. Somebody said to me, well, this is inevitable that in a global market you're going to lose. Why? To London? To Hong Kong? Maybe Hong Kong, because they're sort of backed by China. But why London? Why should we lose to London? We got a lot of strengths. Bigger market, more history of disclosure, better enforcement, a lot of things going in our favor here. And we can play to those strengths. All we have to do is correct obvious weaknesses, and we'll be right back in the game. And that, this is ultimately about whether the U.S. can adapt to the reality of a global marketplace and world where it must compete to survive. Thank you very much. So I'm ready. If you want, Jim, you want to moderate this, or?
Any questions? Again, wait for the microphone and identify yourself.
Thank you. My name is Dan Ekman. I have a question regarding our competitiveness against other international markets. Obviously, I don't think it bears on the philosophical ramifications of the idea of class action opportunities against securities, but has there been any analysis of any sort of a net social loss in nations where there is no class action litigation allowed against companies that could perhaps strengthen the idea that it's not necessary here?
Well, let me put it to you this way. A number of countries have seriously looked at this issue. So in England, for example, over the last 2 or 3 years, there has been an extensive look at what they should do to their enforcement system. And a guy named Paul Davies is a professor. He's done a couple of reports. The Treasury has just come out with a consultation paper to implement. And part of that was, and I've talked to Davies about this, was a very, I wouldn't say it's hard to measure the effect of not having something. But they looked at it very deliberately and said, we don't want it, okay? Japan, okay? If there's one country that you might say this would be a good idea, and it might be Japan, because their enforcement system is terrible, and that may account for the weakness of their markets. People don't trust the Japanese marketplace. They have looked at it, said, no way. China, okay, has examined this. The last thing I hear they want to do is follow the U.S. model on this, okay? So what I would say is in the major competitive alternatives, I don't know that they've looked at it in an empirically satisfying way, although I think it's hard to do that. People have said, should we have this? And the answer is no.
I'm Michael Myers, Executive Director of the New York Civil Rights Coalition. You sound quite pessimistic, and my question relates to an earlier discussion. How much of this big problem, including the failure of Congress to act, is connected with the public's and the shareholders' lack of confidence in the management of these companies and the inability, apparently, of the companies to hold the management accountable, even in cases where there may very well be involvement on the part of management, although there's no admission at the beginning of class action litigation, but at some point the management or the director should know something happening in the company. And secondly, what's the role of insurance? Does insurance cover any of these expenses in terms of lawyers' fees and damages?
Well, there's a lot of parts of that. I don't think the failure of Congress to act on some of the legislative reforms is a result of their concern that management would be protected by the reform. As we've heard, management doesn't pay for these actions. Okay, they're paid by insurance companies. So we should be interested in reforms or enforcement where the people who have done the wrong actually pay. That's the criminal system, civil action by the SEC, okay, and the market. Fire the CEO. We talked about that. So that's where, the discipline for man. It doesn't come from class action.
The public and the shareholders don't have confidence that the management who are involved in wrongdoing are actually fired.
They don't have confidence they will be fired. Okay. Well, maybe so, but more and more are being fired, so they should have more confidence. Class actions aren't going to be the solution to this, okay? As I say, did Bernie Ebbers care that his company someday, not his company, some insurance company for his company, would wind up paying billions of dollars in damages? He doesn't care, okay? So I don't think this is the way to introduce discipline. Bernie Ebbers doesn't want to go to jail. He cares about that, okay? And maybe if Bernie Ebbers holds a lot of shares, he cares when the market murders the share value when the disclosure comes, not the securities class action. By the way, the 41% drops. That's because they're going to be securities class actions. Wrong, because the amount of drop is such a multiple of what is collected in the class actions, even the big class actions. What the market's saying is, we don't trust you if you're doing stuff like this. It's not like, we're pulling your stock down by 41% because we know at the end of the day you're going to have to pay somebody for this.
I have a question. You'd think that people who were for class actions...
I'm a little hard of hearing, so if you would help me out by speaking louder, I'd appreciate it.
Direct me, okay. My name is Henry Stern. I'm with New York Civic. Now, generally, you think that the Democrats would support trial lawyers and class actions and things like that, and the Republicans would be more supportive of companies. Yet Congress was under the control of the Republicans for many years until 2007. Since we had a Republican Congress in both houses, why didn't they adopt any of these measures which you describe as so reasonable?
Well, the one measure I wanted, they didn't even have to do anything. Okay, we were actually proposing a market solution, not a legislative solution. But if your question is why there hasn't been legislative reform during the 8 years of a Republican administration, part of which, by the way, they control both houses in the first Bush administration, I think the answer is kind of the same answer that the companies don't want to do anything. The politicians run from this issue. They do not want to be attacked by ISS, Arthur Levitt, the New York Times, for selling out investors to corporate interests, which is the way it would be played in the press, okay? So this explains why Paulson and Cox, who know the truth of this better than I, won't touch this with a 10-foot pole.
Thank you.
Yes, I'm pessimistic. Oh, well, I tried to say something about the insurance companies. There have actually been some interesting scholarship by Griffith on this and a series of articles that he's written about what do insurance companies do about all this, because they're paying the bill. So you start with the idea, well, maybe they should do something about it. But as I said, what Griffith found is that the insurance companies, first, they generally price D&O liability insurance way above Europe. So our committee in 2006 found it was a 6 times multiple. So the aggregate D&O rates are much higher here, reflecting this liability system. But apart from that, the insurance companies don't go in and monitor on a firm-by-firm basis the kinds of practices that might lead to a securities class action, which they'd have to fund for 2 reasons. It's very difficult to do that, and secondly, you know, they don't have, you know, if the auditors can't do it, why are the insurance companies going to be any better? And secondly, and by the way, the auditors can't do it, and secondly, you know, they can't figure out how they would price this. It's just difficult. So the Griffiths articles really conclude if you're looking for hope for the insurance companies to control this problem, forget it.
My short answer question is the concept of an independent director an oxymoron? I ask you that question because being involved with charitable not-for-profit boards, the notion of a CEO recommending someone for the board is absolutely inappropriate. Nobody would even do that. Yet we all know, as a practical matter, that the majority of board members in commercial public companies are recommended by the CEO, who are basically supposed to be the ones overseeing. Is there something wrong with this system, that the definition of an independent director does not exclude CEOs recommending their cronies to be governing them?
Well, it's a little far afield from what my subject is, but I'll respond to it anyway.
Okay, good.
You know, if the question is what should be the role of CEO in selecting board members, you know, I think I'm on a board, so I've thought a little bit about this. You know, if the CEO can't live with the board members, independent board members, you got a problem with this company, okay? That's not to say the CEO should select the board members, but let's say the CEO says, you know, Joe, look, he and I go way back. You know, he represented my wife in our bitter divorce, okay? I don't want him on this board, okay? I think that's fair. I don't think it is fair for the CEO to say who's on the board, but I think it is fair, the board, in its own interest of having a well-governed company, hear what the CEO has to say, because the board and the CEO have to work together to make the company successful.
Well, I'd like to thank Professor Scott. I'd like to thank you all for coming, and I'd particularly like to thank the Institute for Legal Reform at the U.S. Chamber. We're excited about this new research. I hope you all will read the report in more depth, and we look forward to seeing you again in the fall. Thanks.
I think it is clear how fortunate we are to believe in the power of ideas.
Supply the common sense and the fresh thinking of the Manhattan Institute.